following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Hello, everybody, and welcome back to the Advisor's Option. I love that music, that Bond-esque theme. It really gets me in the mood to do this show. I'm looking forward to a lot of great comments, a lot of great discussions today on the Advisor's Option program. And joining me on the Advisor's Option Roundtable is my cohort, my partner in crime, Randy Swan, the co-founder of Swan Wealth Advisors. Randy, welcome back to the program.
All right. Thanks a lot for having me.
It's great to have you, Randy. It wouldn't be much of a show without you. Just be me talking into a microphone, and really, who wants to listen to that? So much better to have two of us on the old show. And speaking of the show, we're going to do something a little bit different today. I think a lot of you will be interested in this. I know a lot of you have been contacting us here at the program, writing us with questions and comments and things to discuss on the show. So we thought, what better thing to look at today, what better topic to discuss than actually all the topics that all of you guys want to discuss out there in the listening audience. So we're going to devote an extra special episode, if you will, to the old Advisor's Options mailbag today. And we're going to dig up some interesting topics for discussion and kick them around a little bit for you, the listener. So without further ado, let's dive right into the old listener mail segment.
Listener mail. Listeners write in.
Mailbox.
All right, and now it is time for the listener mail segment. This is, of course, the portion of the program where you, the listener, get your chance to sound off and join Randy and I here with your questions and your comments and indeed your insights on the worlds of advisors and options and how they intersect. And our first question comes in from Jackson CFA. I like that handle. He writes, what do the hosts think of annuities as a tool for diversification and income generation for risk-averse clients? And I wanted to include this one in the mailbag today because we've received many different variations on this question and on this topic in general. There are a lot of advisors out there and CFPs and other different financial managers out there who've come to embrace annuities over the years. They really turn to them as this source of locked-in income, and they're very they're very useful for a lot of people. Like to use them anyway for the older clients, the more risk averse people pushing towards retirement who need to preserve capital. So they turn to annuities for those types of things. And traditionally that has been the choice for the advisor looking for income. I would like to think that if you're an advisor who is savvy enough to listen to this program on a regular basis, that we've outlined a few alternatives for you here on the Advisors Options program that would allow you to at least have some options, pun intended, when you're thinking about things like income generation. For example, we've outlined many different strategies on this program that could allow you to accomplish that. Of course, the covered call, which is the flagship standard bearing income generating options technique for a lot of financial advisors out there, and for a lot of you who have clients who are pushing retirement, who are getting towards that age where they are a little more risk averse. A covered call is a great strategy for them because it allows you to at least turn a little bit more income out of their portfolios rather than just the traditional buy and hold. Of course, if they are risk averse, you can also use the covered call as a way to offset the price of protection, constructing collars, which we've also talked about. In fact, we devoted an entire episode to the collar, which is many advisors' favorite position when you're talking about using options in conjunction with the underlying. So I think in a nutshell, Jackson CFA, my opinion on annuities is that there is a time and place for them, but I think a lot of that time and place has passed for many of the financial advisors out there who are looking for interesting options for their clients in terms of income, and certainly in the diversification realm. I really wouldn't include annuities. I wouldn't lump them in on the diversification side of the fence. I think there are other better tools that you can use for that. Broader based indices, of course, some of the volatility products and some of the option products we've discussed on this show that give you exposure to volatility as an asset class, one of the truly inverse, I should say, correlated assets to the underlying equity market. So there are a lot of tools I would prefer for that, for diversification and for income generation for risk averse clients. I think the notion that options are this terribly risky thing and that adding them to a risk averse client's portfolio somehow increases risk is a very flawed assumption. I think we're going to get to a little bit later in the mailbag. An article just came out in the New York Times that kind of hits on that same note again, and we'll debunk that a little bit. But interesting, and that's kind of my take right now on annuities. I think maybe down the road, because this question is so common, I think we'll devote an entire episode to really exploring annuities and the fact that I think a lot of people forget that they give these to risk-averse clients who they think are too risk-averse or perhaps afraid of using options or derivatives, without really taking into account the fact that most of these annuities products are riddled with derivatives within them. That's how they generate these regular income streams. So it's a bit of a catch-22 when you're looking at these products. Now, Randy, I know you don't use a lot of annuities out there, but obviously you interact with a lot of the advisors in this space, a lot of advisors who probably use annuities on a regular basis. What's your take on these advisors kind of leaning toward annuities as a bit of a crutch for these types of tools for diversification and for income purposes?
Well, I liked your idea about the covered call, first of all. I guess another option I would throw out there was be selling out of the money puts. That gives you a little more downside protection, or maybe selling puts a little further away from the money. I think that's an additional way to generate some income with some lower risk. But in terms of annuities, I guess you always have to be careful, in my perspective, of what kind of fees are associated with the annuities. Obviously, if they get really expensive, it really diminishes your return potential. And some of the structured products that we look at really, quite frankly, have very low possibilities of generating any real return. So I think those are my two comments in terms of structured products or annuities that people may be considering.
Yes, the advisor space is literally riddled with structured products. A lot of them, either they're annuities or they're products that attempt to replicate what options can provide for you, but doing it in a one product type sense that is a little bit more palatable for some of these advisors who like to just come out and buy products to perform certain functions for them. And so these structured products have sprung up, and I tend to agree with you, Randy. A lot of them are certainly not as efficient or as cost effective, particularly when you factor in fees, as doing it yourself from an options perspective. So that's always the approach that we favor here on the show. But again, I think this topic of annuities, and maybe even bigger, the structured products in general, and how they're being pitched to advisors, particularly the ones that attempt to replicate what options can do for you, either covered calls or protective puts or what have you. there's a lot of fodder there for us on the show to discuss, because we see so many advisors being lured into that realm right now and saying, well, I don't want to use options. I'm going to buy this product from Group X instead because it replicates the covered call, and I don't have to do anything. And they don't know that the fees and everything else and the actual amount of replication that it does is pretty poor, and a lot of other problems that go into products like that. I think that's an interesting topic for a future show. But a great question, Mr. Jackson, CFA. I hope that at least points you in the right direction. We tend to take a dim view of those products overall. All right, next up we have a question from Alexander Sarsgard, writing out of sunny and scenic Portland, Oregon. And he writes, just adding puts to your clients' portfolios is expensive. What is your favorite methodology for reducing the cost of protection when structuring client portfolios? A great question, Alexander. We hit on this a few times on the show. In fact, like I mentioned earlier, we did do an entire episode devoted to this topic in general. And I don't have the episode number off the top of my head, so I'm going to pull it up while we're talking. But essentially, there are a lot of different ways you can do that. Because you're right, just buying puts by themselves, if you look at, let's say your client is in a broadly diversified portfolio and he wants to trade SPY options against it, maybe hedge with SPY downside puts, you're right, that can be an expensive proposition, particularly if you're rolling them every few months or so, and the client could balk at that and say, why am I paying all this money when the market, particularly in this environment when the market is rallying, you're probably going to get a lot of calls from those clients saying, why are you wasting so much money on my protection? And there are a lot of different ways you can overcome that. And let me just, while we're looking right now, yes, so the episode, I've just found the number. We don't have the episode number, but if you look for the episode from December 14th of the Advisor's Option, it is entitled Collar Strategies, and that will really walk you through a lot of these topics here. But essentially, there are a lot of ways to do this. The put by itself is expensive. If you are in an environment where you're not dramatically concerned about very, very pronounced near-term downside move, you just want to protect against a mild near-term correction, then a put spread could certainly work in your favor. Of course, keep in mind that that will curtail the amount of downside protection you receive. So if you're looking at put spreads, and particularly if you start getting into things like ratio put spreads, be careful, because you know that certainly can turn into a loser on the downside if you start doing extreme ratios. And we see a lot of people certainly take that approach once they discover the magic of the put spread and the ratio. They start adding those ratios and it becomes 1/3 and 1/5, and next thing you know, they're losing money dramatically to the downside. So that's one way, is the put spread. But I think the collar, like we've said, really is the attractive option, pun intended, for a lot of our listeners out there. It allows you to write that covered call against the protective put element and offset a substantial amount of the premium you will outlay for those puts, particularly if you structure your collar in the right way. And we'll get into that in a little bit. So I tend to, whenever I'm talking to advisors and asset managers, always discuss the collar as a really opportune investment for them. Of course, keep in mind that, again, in this market scenario, if you're writing very near at the money calls or very close out of the money calls, you're going to be clipping some of the upside in those portfolios. But as long as you understand that and are comfortable with that, and the client is, and we also remind the client that when your stock's getting called away, it actually is a good thing. The strategy is working. That's something we like to remind our advisor listeners of quite a bit. Don't be afraid of having your stock called away. But in general, the collar seems to be very much the silver bullet for a lot of advisors in this space. Now, Randy, I know you utilize a lot of protective put and collars in your overlay strategies over there. So I'd imagine you probably fall on that spectrum as well, of being a big fan of the collar when you looking for strategies to mitigate the expense of just buying downside puts outright.
Yes, well, I guess I have two comments. First of all, our experience over the last almost 16 years is that buying puts systematically over a long period of time actually is not as expensive as a lot of people actually believe. Now, maybe that's because we've experienced 50+% declines in the markets over the last 15 years. But generally speaking, I would say that buying puts by itself can be inexpensive in certain circumstances, especially if you're buying short-term puts. What our strategy really relies on is a put spread plus a covered call type strategy. So you could call it a collar plus strategy or a put spread and a covered call. But we think all those things combined together really gives you unique risk-reward profit. And we think that is the best way to help pay for the hedging costs when the markets are roaring up like they are right now.
So that's interesting. That's kind of like a collar with a put kicker on the side to add a little bit of extra income, a little bit more offsetting for the price of the put. And it's funny you should mention that, because we did have an interesting guest on one of our other programs a few weeks back, the Volatility Views program. I suggest all of our listeners check that out, because he made a similar point. He did a lot of research and looking at different asset classes and how they hold up over time, particularly from an options perspective, and how they survive their decay and which ones survive decay the best. And when you think of an asset and a region that is probably the most overpriced from a risk-reward perspective and also suffers the most from decay, I think a lot of people would naturally gravitate toward that near out-of-the-money put wing in the S&P, because everyone's got all this black swan risk priced into these things, and the price you're paying to hedge your tail risk can be extreme in those scenarios. And what he found in his research is that those puts actually hold up surprisingly well. I think for a variety of reasons, not the least of which being that so many people are flocking into those puts looking for that tail risk and are willing to pay these exorbitant levels of premium to do so, that they tend to maintain their value a little bit better over time, and they don't suffer the ravages of decay as badly as you might think. So that was a bit of a surprise development for me, and it sounds like some of your research and some of your findings, some of your returns over there at Swan, Randy, tend to correlate that that really is it's not as expensive of a proposition when you look at it, particularly when, as you outlined, when you factor in the entire lifetime of that investment and looking at some of the big downturns we've had in the market of late. When you factor the returns in on those days, then certainly the put and the put spread start to look a little bit more attractive, I think, for a lot of advisors and asset managers out there. All right, next up we have a question from Tim Dinahar. I suppose hope I'm pronouncing that correctly, Tim. If not, don't hold it against me, from Houston, Texas. And he writes, do I really need to understand the Greeks when writing or buying options for my clients? Or is everything I really need to know encapsulated in the options price? Thank you very much for this insightful program. I don't think anyone else has tackled the advisor space quite like this. And thank you for your question, Tim. You're right. This is a very unique program. And we launched it for that specific reason. We didn't see anyone really addressing the needs of this space, particularly from an options perspective. So we thought this was a unique opportunity for us to launch a program very targeted at the advisor's audience. Now, Randy, you obviously deal a lot with the Greeks and with the different aspects of constructing your overlays in your portfolio. So what do you have to say here to Mr. Tim, who writes in wanting to know if he really needs to understand all this stuff he hears about the Greeks?
I think the Greeks are very important in every option trade. I think every potential investor or advisor that wants to use options really needs to spend the necessary time to learn about the Greeks and develop programs and really understand how options are priced to, quite frankly, make sure they can set up a trade or a series of trades that gives them the best possibility of profit. So I would just remind people that most of the people that are trading options for a living, like myself, do pay attention to the Greeks. So it just seems logical that everyone knows what they're getting into.
Yes, I definitely agree with that, Randy. You know, it is tempting, Tim. I see where you're coming from to say, well, everything I need to know really is encapsulated in that options price. If volatility or Vega is getting higher, the price of that option is going to get higher, and things like that. If there's a lot of decay going on, I'll be able to see that in the change of the price day to day. So I see where you're coming from. I hear a lot of people making that same point when they're first getting into options. Well, everything I really need to know is right there in the option chain. And that's true to a degree, but at the end of the day, if you're going to be doing this on a regular basis for your clients and looking to maximize the amount of return you get out of it, the amount of protection you get out of it, you really need to understand what it is that you're doing and why the options are performing the way that they're performing in different scenarios. And the Greeks are pretty much the gateway to doing that. If you don't understand delta, you're not really going to understand how your options price changes as the underlying moves. If you don't understand Vega, you're not really going to understand things like how volatility impacts the price of that option. You might know general things like volatility is higher, the price will be higher of the option, so that's more favorable for writing options and things like that. But that's really only a surface understanding of what's going on there. And then things like gamma and the relationship between gamma and theta, which are, of course, inversely correlated. That's a very, very sophisticated relationship and something you really need to understand if you're going to be writing a lot of options, particularly if you're going to do things like rolling things into other months and essentially legging into time spreads. The relationship between gamma and theta is particularly important and probably one of the most crucial things that underpins the understanding of options for a lot of professionals out there. So if you're going to be writing options on a regular basis, or buying options, or constructing collars, or whatever you're going to be doing with your clients, doesn't matter, buying or selling, you really need to understand how these prices work, how they are arrived at in the marketplace. And the only way to do that really is to understand the Greeks. I know it might not be the most fun reading to sit up at night and sit down and read a chapter or two on the Greeks. One of my co-hosts on another program, Dan Passarelli, wrote a great book about the Greeks, Trading Options Greeks. I recommend you take a look at that if you're really interested in learning about the Greeks. And it may sound basic, it may sound rudimentary, you may think you want to skip that step, but that really is the foundation, the building block upon which all the other options knowledge you're going to use is built upon. So if you ignore the Greeks and kind of just jump to the next step, you're not going to understand why that time spread isn't working out the way you think it is, or you're not going to understand why this option is really decaying the way it is in this environment, or why this put is so expensive when you really think it shouldn't be. And things like that, the Greeks will help you make sense of those, and that is certainly something you need to have when you're trading options on a regular basis on behalf of your clients. So you may not like the answer, Tim, I'm sorry, but at the end of the day, yeah, go pick up Dan's book, go pick up Macmillan, go pick up Natenberg, Options, Volatility, and Pricing, the Bible for many people, particularly from the professional trading realm. That will certainly walk you through the Greeks in substantial detail. So a lot of interesting stuff there for you, Tim. I'm sorry, you gotta start at the beginning like everyone else did when it comes to proper use of options. Speaking of the proper use of options, the next question comes in from Anthony DeShanti from Syracuse, New York, about a very similar topic. And he says, how can I approach the topic of options with my clients when mainstream outlets like New York Times are slamming options as risky and dangerous? And if you don't know what our friend Mr. Anthony is referring to, listeners, there was an article actually this past weekend. We're recording this on May 28th, so it was around the 27th or 26th, I believe, in the New York Times, entitled Growth in Options Trading Helps Brokers But Not Small Investors. And what this article did, really, it perpetuated a lot of the stereotypes we've seen hurled against the options market and the options product in general for many, many years now. And it kind of hit on a lot of the old beats that options are risky. They add risk to the client's portfolios. In fact, they even slam here in the article some brokerage firms like E-Trade for saying every investor should learn how options trading could benefit from them. I think that's a very, very true statement. I think every investor should. So I think slamming brokers for embracing these products is a little bit misguided. And of course, you're right, Anthony. This is the kind of thing that's going to scare off your clients when you approach them and say, hey, I think I want to add a covered call to your portfolio. They're going to say, wait a minute, I saw that article in the New York Times, the bastion of journalistic integrity, and I think these things are too risky. And that's kind of the downside of all this stuff. And I think that's what we've hit on time and again on this program, is that there is a proper use case for options. And that's what we've really tried to stress on this program. I think maybe what some of the things they're getting into in this article are a lot of these customers coming in and doing things like I just outlined, doing a lot of extreme ratio spreads and writing a lot of options and just selling options willy-nilly. And of course, those accounts tend to blow out over time. And that is a very much risk additive approach to using options in your portfolio. But if you're doing the approaches that we're talking about here on this program, covered calls, protective puts, collars, things like that, these are things that are very much risk mitigating approaches to using options. And I didn't see the article really differentiate between those two approaches, the very much the proper use case of options and the more speculative use case for options. They kind of leaned much more toward the latter, and they tend to draw a very negative conclusion because of that. When in reality, there's a lot of, everything we talked about on this show, all the things the guys over at the OCC are doing, and OIC with their education initiatives, everything we've done at Options Insider, of course, a lot of the work you've done out there, Randy, evangelizing options to the advisor community, a lot of that has all been to kind of counteract a lot of this perception that permeates the marketplace because of articles like this. So yeah, you're right, Anthony. This kind of article is scary to a lot of clients, but I would just caution them and hold their hand and say this is an article about the improper use of options. We're going to use these options in a proper fashion to reduce the overall risk of your portfolio and indeed perhaps add an income stream at the same time. And I think that's something that would resonate with clients a lot more. Now, Randy, obviously you deal with these clients for a living, so you've encountered this many times in the past. First off, give me your take on this article in general and what you think of it, and then B, how these kind of things tend to sometimes poison the advisor-client relationship, particularly when they start talking about options.
Well, I think the first point is that the article does not differentiate between a strategy or a program that uses options in the proper sense and those speculative purposes that we can all use options for. And that's really the central problem or premise of these articles. Do not really do justice to the proper use of options. We start out with our firm and always talk to people about, we insure every aspect of your life. You insure your life, your health, your car, your house, etc. Why not your portfolio? And of course, when you insure your portfolio and you put it in the proper context of what percentage of the assets in a portfolio is going to be going to or allocated to use options, quite frankly, for us, it's a relatively small amount. So we may spend on an annual basis, let's say maybe 10% of the portfolio to buy maybe a 2-year put option, and then do monthly income strategies with a very small percentage of the portfolio, typically 2 to 4%. So we think that is the proper way to use options and just keep everything in the proper proportions. This article does not differentiate between that and let's say taking 10% of your portfolio and buying a call spread. That obviously would be using massive amounts of leverage. I see it all the time in terms of the brokerage industry, and the brokerage firms really struggle between differentiating between those also, where you say, hey, approving someone for options gives them carte blanche ability to really do blow up their portfolio and use massive amounts of leverage or overwriting, versus what we think is, as we already discussed, the proper use of options. So there's no discussion in this article about that proper use and delineating between those two users.
And I'm certain you've probably bounced into this in some way, shape, or form in your advisor career over there. Obviously, you're dealing with a little bit larger clientele now, not so much the mom and pop client that a lot of our listeners may have. But still, you must encounter this even still when dealing with large funds who, quote unquote, should know better. They read articles like this and they probably come to you and say, wow, I'm not going to use your SWAN risk overlay because that uses options and that's going to add to the risk of my portfolio. So how often do you encounter this, and how frustrating is it whenever you see something like this kind of perpetuating that stereotype?
We're seeing it less and less, but it definitely comes up occasionally. I have a funny story. I think it was in 2009 where we ran across a consulting firm that was advising for some big pensions, and their portfolios were down about 30% in the 2008-2009 sell-off. And the guy just said point blank, I'm going to keep doing what I'm doing. I think this is the way to do it, notwithstanding that I lost a third of my client's portfolio. And I think that's pretty amazing. So there's definitely people out there that have come along slowly, and there's some people that you may never be converted over to using options or portfolios. But generally speaking, we're getting a tremendous reception in terms of the advisors and other professionals that we're talking to that truly do see the reason or the benefits of using options in terms of designing portfolios that maybe have a lower beta or lower standard deviation than your traditional portfolios. And of course, we always attack it from the asset allocation perspective. Every advisor or every consultant should pick money managers that actually are non-correlated. And in the 2008-2009 sell-off, without using hedging, without using options, I have yet to find someone out there that was able truly to have non-correlated assets to the market in general, with the exception of maybe treasuries.
And that's an interesting point that came out of this article too, is that options use exploded post 08-09 meltdown in the financial markets. And I wanted to, in fact, I've been in contact with this reporter now, and I'm probably going to help him write something that makes a little bit more sense from an options perspective, perhaps for his next article. But just kind of pointing out some of these issues with the article, including the fact that he mentions that so many people dove into options post 08-09, and that actually is a good thing. That's what you want to see. That's people waking up to that exact fact you just highlighted, Randy, that you can't avoid another 30+% drawdown in your portfolio unless you have some sort of protective component in there. You can't just diversify it away by buying more stocks. You have to have a protective put, a put spread, something along those lines to mitigate that downside risk. That's really the only way to do it. And I think people coming to options in droves post 08-09 is not a bad thing. It's actually a good thing. That shows that people are waking up to that fact. And I wish more people did wake up to that fact, because then it would make it much more difficult, particularly on the money management side. Some of these larger funds who still don't really grasp those concepts, if they did, it would make it much more difficult to have a repeat of that 08-09 meltdown, because they would be protected. And so
well, I would also just add another point. Notwithstanding that options is a more complicated subject than traditionally investing in stocks or bonds, but there is a learning curve. Let's just acknowledge that you don't pick up options from the get-go and this becomes an easy thing. This takes time. So I would argue that even if investors do lose some money on the front end, if they stick with it and remain disciplined over time, they will fine-tune their skills and become better at using options. And at the end of the day, they will end up with a better product or a better designed portfolio to withstand the bit large sell-offs in the market. And it does take time, though.
And I haven't had a chance yet, the article just came out, to really contact some of the researchers he cites in the article that somehow have all this data about how options have been massive drawdowns to their portfolios, and how these traders, these retail investors who've added options have dramatically underperformed, I should say, people who've just been holding stocks that entire time. He seems to make an argument in the article for buy and hold, which I thought was disproved many, many years ago, but c'est la vie. So there's a lot to really dig into with this article. Great question, Anthony. And I think I'll try to reach out to some of these people in this article and see if we can bring them on this network down the road to maybe dive a little more deeply into some of these topics they're raising, have a little bit more nuanced perspective on it, and perhaps even debunk some of the findings that they kind of just glossed over in the article. But yeah, this is the kind of thing, unfortunately, Anthony, is going to make your job harder, because the clients are going to read this, and it's not some rag out in Des Moines. This is the New York Times saying this, so it carries a little bit extra weight. So that's the job of people like us on this show and others who are a little bit more knowledgeable in this space, to help counteract some of this type of more, shall we say, sensational approach to the options space. Okay, great question, Anthony. Next up, we have a question. This is a great one for you, Randy. A question from Mr. JBerg. Love these handles on our Twitter followers. He says, what time frame do you use when constructing collars or risk overlays? 6 months is my preferred time frame to buy the put and sell the call. Randy, why don't you walk our listener here and all of our listeners through what methodology you guys use when you're constructing your overlays, and what you found to be the most viable time frame when constructing those types of positions.
Well, we actually use multiple time frames on our strategies. So we typically will buy 2-year put options on the S&P 500, hold those usually about a year, and then trade those out, roll those out another year. And then our option income strategies are typically 1 to 3 month option strategies. So we may do calendar spreads or butterflies or covered calls or put spreads. But typically, when we're selling the options, we're doing them at a shorter duration than what we're buying in our long-term put options. So in the traditional sense, we're not doing a collar on any type of time frame that's all one time frame. We're using various time frames on all our option strategies. If I was looking at a collar strategy, obviously I would look at the Greeks on any individual trade and play around with different durations to come up with the best, what I thought would be the best profit return, risk reward ratio at the end of the day.
And I wanted to include this question because it really reflects what a lot of advisors ask us, and what a lot of advisors think of when they're constructing collars. They tend to go right away for that zero cost collar. They want to have a zero outlay for their protection. And what that usually involves is buying a put and writing a call in the same expiration month. And there's nothing inherently wrong with that. That if that works out and that's your goal for, constructing that zero cost outlay collar, then that certainly can work for you. But when you take that approach and you're focused that so much on the zero net outlay, you're kind of forgetting some of the other things we've hit on many times in this show in the past. And that is particularly the impact of time decay and how time decay works across the expiration months. And this gets back to our earlier question about understanding the Greeks. You really need to understand the Greeks in order to construct these things effectively. And if you understand the Greeks, and hopefully if you've listened to this program, you have a bit of an understanding of that, you understand that time decay works differently in the near-term months versus the far-off months. And essentially, when you're constructing a proper collar, when you're doing it in the proper manner, like the way Randy outlined, you want to tend to extend the reach of the long portion of that collar, so the option that you're buying, the put in this scenario, farther out. The farther out you extend that, of course, the less of an impact time decay will have. And of course, you want to do the opposite with the selling portion of that collar. You want to maximize the amount of time decay you're collecting. So you want to get that closer to the nearer term side of that equation. And there's a lot of different research on what is optimal for the different months, and of course that's going to depend on what your scenario is and what's favorable to you as well. I would encourage you, if you haven't had a chance to, listeners, to check out some of the research the OIC has done on this exact topic, including collaring the Qs. I believe is one of their most recent articles about constructing collars and doing it in the most optimal fashion. They found buying a 6-month put and writing a 1-month call was indeed the best sort of secret sauce, if you will, of avoiding paying too much for the put and also at one time, and also avoiding having to pay a lot of time decay on the put by buying just a 1-month put, and also maximizing the amount of decay that you're collecting with the call. And I would also caution you to remember, listeners, that just because maybe the initial cost of that position is more than maybe you might want to expend, it's not a zero net outlay position. Remember, you're going to be rolling that call every month, and because you're maximizing time decay in that sense, if you buy a 6-month put and roll a 1-month short call every month, by the time you catch up to that put, you probably have collected more in time decay writing the calls than you paid for that position. So you are actually collecting money. At the very least, you've offset a substantial amount of the price of that put. So that's why I caution a lot of our listeners who focus on the initial outlay of the trade to perhaps look at it in a more longer term perspective, because when you take into account the full lifespan of that put and all of the option writing you're going to be able to do in the lifespan of that put, you're probably going to offset a dramatic amount, if not all of the cost of that put. So constructing it in the right way really does dramatically improve your return. So that's kind of how we fall on it here. Randy takes the 1-year approach with the 1-month call. Again, every scenario is a little bit different. Every use case is a little bit different. But in general, you want to extend the buying portion of the collar as far out as you possibly and reasonably can without paying too much in terms of extra time premium. And you want to make sure the selling portion of the collar is as focused as far to the near term as you can. Of course, we have weeklies now, so that changes the equation quite a bit. Some advisors have migrated the selling portions of their collars into the weeklies. That, of course, maximizes your time decay, but it also generates more commissions, and it's more time intensive. You have to do that 4 times a month versus once a month for the monthly option. Randy, have you investigated using the weeklies at all? Is that just too much of a time commitment for you guys over there versus what you get a little bit extra theta you're collecting?
We have looked into it, but as of right now, we're sticking with our basic strategy. It would be very we also, obviously, in addition to our fund managed SMA program, and so doing that on the thousands of accounts that we manage would be probably prohibitive right now in terms of the weeklies. But in terms of the big picture, in terms of what we try to do is we kind of theoretically feel that the annual cost of buying put options just from time decay would typically be about 3 to 4% of our portfolio, and so we're shooting on our income trades to on an annual basis of about 2-to-1 ratio. So we're hoping to collect or make twice as much money in income on an annual basis as we would probably spend on buying the puts, and that's the kind of how we manage our strategy.
There you go, listeners. There's where the rubber meets the road right there in terms of if you look at it from a more, I hate to say holistic perspective, but from a full portfolio, a full position perspective, the net, Randy's obviously paying more at the outset of the trade to buy that 1-year put, but over time, as he's writing those consecutive calls, he offsets that price by a dramatic margin. So keep that in mind when you're constructing your own collars. And I think, Randy, a lot of advisors fall into the same group as you, where the weeklies may be attractive, but the added effort that goes into them probably isn't worth the additional amount of decay you're going to collect. And maybe somewhere along the line, someone will come up with a tool that makes it easier for guys like you to roll all these calls across thousands of accounts simultaneously. But until that day happens, I think the trade-off for advisors is always going to be time versus that little bit extra return you can get. So an interesting discussion and a great question, Mr. JBerg. Good handle, by the way. Next up, we have a question from Alejandro Vega coming to us from sunny and scenic San Antonio, Texas. And he writes in, this is actually a great question as well because we get a variation on this all the time, so I really wanted to answer this here on the show today. He writes, I don't use options in my client accounts. If I want leveraged exposure to different underlyings, I simply turn to leveraged ETFs. What do you think of using these instruments in lieu of options in client portfolios? Am I missing something by not using options? And Alejandro, I wish I had a nickel for every time someone has written some variation of this question to us. I often, in general, refer to these levered ETF products as the poor man's option, because that's exactly what they are. They offer some of the benefits of options without all of the heavy lifting you've had to do, like our earlier listener wrote in, says, I don't want to have to learn about the Greeks. Well, guess what? If you buy levered ETFs, you don't have to learn about the Greeks. You can just buy this thing and whatever happens, happens. So in many senses of the word, they are very much that poor man's option. They approximate some of the return and some of the leverage of an option without requiring all the extra work on your part. But of course, the downside of that is, of course, the performance is not there. And they really aren't, even these levered 2x, type options or levered 2x ETFs and 3x, whatever the ratio is, they tend not to perform on that pure 3x, 4x advertised ratio. It's usually some fraction they're in. That's because they have to construct these things, again, using options. And you never know, unless you're very sophisticated, really how these things are constructed and if they're constructed well versus ones that are constructed poorly. We see these things come out all the time that are constructed very poorly, and they bring in a lot of influx of investment, and then they either collapse. I think TVIX is a very infamous example of that. That was, of course, that wasn't a levered product, but it was an ETP on the VIX, and it kind of exhibited a lot of these problems we're talking about here of a very poorly constructed product. Didn't really replicate the underlying very well, and then it had a massive inflow of funds, and it kind of just destroyed the product. We see that happen with a lot of these levered products as well. They're poorly constructed. I would caution anyone who gets into these things to really dig into the prospectus to see how they achieve these advertised 2x and 3x returns, because if you're leery of using options on your own, yet you're buying these levered products, you are in fact using options, whether you understand it or not. And that's something that I think a lot of clients may be resistant to if they're resistant to using options. And also you should be cautious of that, because at the end of the day, you're using a product you don't really understand very well, and that's never a good thing. So are you missing something by not using options? Yes. You're missing the control that you have by constructing this portfolio yourself. You're missing the true amount of return you can generate by doing it yourself versus relying on some third party that may or may not be constructed in a favorable fashion. This again goes back to our discussion earlier of the structured products, a similar product problem with these ETPs and these ETFs that are levered. These are structured products, and whether they are structured well or not, it varies on a case-by-case basis. And unless you're sophisticated enough to be able to determine that, I would certainly caution against relying on these. And certainly using a levered ETF as some sort of portfolio hedge is madness. They don't work that way. They reset every day, so you're just costing yourself money by doing it. It is certainly not approximate to buying a put on your portfolio. It certainly is not the same thing at all. So if you're relying on these levered ETFs or ETPs to approximate some of the defensive or hedging aspects of options, then you're really missing the boat, because they don't really perform that function at all. Now, Randy, I've said my little bit on these levered ETPs and ETFs. So what's your take on these products overall?
Well, I was just going to add to your comment about the settling out of every day or restructuring. So if you buy, let's say you won it 2 times on the S&P 500, and you buy it at the beginning of the month, you think the market's up 10% for the month, you should make 20%. But as you said earlier, they're going to reset that value every day. So what you may end up with may be drastically different than what you thought going into the product. So I think that's the fundamental problem, is you just can't control or know where these things are going to settle out. So I think you said that, and I'm just trying to reiterate that point.
I'm always happy to have my points reiterated, Randy. But yeah, it is, you'd be amazed how many people write into us thinking they can use these levered products as these defensive type products. And I keep reminding them, wait a minute, they reset every day. So it's not exactly the same thing as buying a put. And you'd be amazed how many people don't grasp that simple fact, and they try to use them. Oh, this is my portfolio hedge. And not exactly the same thing. Certainly if you're long the underlying and long some 2x short ETF that resets every day, not the best scenario, particularly if you're still bullish the underlying. All right, great question, Alejandro. Like I said, I encourage all of our listeners who are interested in these levered products to perhaps listen to our earlier episodes, check out the Options Insider, contact a guy like Randy or maybe the guys over at the OIC to learn a little bit more about these products, and how options can really be a more effective way to implement that in your portfolio, certainly without all the fees and certainly with a much more accurate and, shall we say, truthful replication of what's going on in the underlying. All right, next up we have a question from Mr. Nick. A lot of great handles going on here in our listening audience. And this is the question directly for you, Randy. He writes, can I, as an individual investor, buy into Randy's fund? And if so, what is the ticker? So, Randy, I'll let you take this one.
Absolutely. Individual investors can buy into the fund. The easiest way to buy into the fund was going through Gemini, which is the fund administrated company. They can buy directly from Gemini. The other ways to do it is go through the main brokerage firms. The list is too long on how many different places you can get our fund, but the big ones in terms of Schwab, Fidelity, TD, Interactive Brokers, some of the other brokerage firms have them. But yeah, pretty much it's not a big deal to get into those funds. The institutional share class, which is what we recommend for individuals, is SDRIX. And that requires a minimum investment of $100,000. If someone has less than that, then they can go directly to the fund, and I think get that.
So there you go, listeners. You too can participate in Randy's fund. You don't have to be some massive institutional investor to buy in there. And maybe we should just quickly reiterate for our listeners what that fund does replicate. That is indeed the one that has the risk overlay, the collar type overlay on the S&P 500, correct?
Correct. So right, we go out there, we invest about 85 to 90% of the money into the select sector spiders. We hedge it with long-term put options on the S&P 500, and we generate income using various vehicles, as we talked about: strangles, butterflies, calendars.
So there you go, listeners. When it's handled in the right fashion, some of these products, or indeed these funds that do attempt to give you all of the returns of the options, they can be a great tool for advisors who either don't have the time or the skill set to really actively and effectively implement options in their portfolio. Like we've said many times on the show, we just want you to be cautious about the products that you choose to use in your clients' accounts, because not every product that uses options to quote-unquote hedge or to quote-unquote generate income is created equal. So certainly be aware of that when you're diving into all these products. And that's why we like having Randy on this show, because they do it in a much more proper fashion, to say the least, than some of these crazy levered things we've seen floating around out there that are trying to go after advisors and lure them into their funds. All right, great question, Mr. Nick. Next up, we have a question from Jim Schulman out of Mobile, Alabama, and he writes, adding options to client accounts would generate significant fees to accommodate opening and closing the positions, rolling to new strikes, etc. Do you find your clients are receptive to these instruments even with the added costs? Interesting question. We get a few of these questions every now and then. Obviously, the goal of implementing options into portfolio is to generate returns or protect your returns in a much more substantial fashion that will certainly dramatically supersede the fees you're generating for doing that. But still, Randy, I'll let you run with this one a little bit, because obviously this is a question you probably encountered with some of your clients saying, hey, all these options you're trading, isn't that going to eat into my returns? And what do you typically tell those clients?
Well, at the end of the day, the proof is eating in the pudding. Either you make money from all your option strategies, and I mean typically your income strategies, or you don't. So yes, you do have fees associated with trading options, but incrementally speaking, do you or do you not make money in your strategies? If you make money, then it was value added, it was worth doing. And of course, we take a longer term approach to generating income. So historically speaking, we've been able to overcome the cost. I personally believe that in terms of most of the trading platforms that people deal with now, the trading costs have gone down significantly. I laugh. I remember one of my first trades I did on the SPX, where I think I sold 3 calls and it was $40 in commissions, and now I pay about $2. So trading costs have come down. I think the spreads have come down. The proliferation of options out there have made it more favorable, I think, for individual investors as well as advisors to use options. So ultimately, it comes down to, do you not make money? If you're losing money on options and it's because of commissions, ultimately, then maybe you should stop doing those strategies, or maybe try to improve the strategies somewhat so you do provide additional income. One of the other things that we've done recently with some of our clients and some of our strategies is we've actually negotiated with some of our firms that we deal with an asset-based pricing type deal, where we can generate, or we can do additional income trades that aren't really based on a commission by commission or a trade by trade basis. So we pay a flat fee for the account, and so that allows us to be a little more aggressive in terms of the number of trades that we may be willing to do, and it doesn't increase our trading costs.
At the end of the day, you're right, Randy. If the costs are superseding what you're generating from the trades, then you're probably doing something wrong. And that the proof is certainly in the pudding. If you're costing more in transactions for your clients than you're adding with these option strategies, then you certainly perhaps should reconsider what you're doing. I think Randy's example is a good one. Looking at these calls, he's buying the 1-year put, he's rolling the call every month. Certainly the call rolling every month is generating additional commissions, but he's right, the competition between brokerage firms has really dramatically reduced the amount you're going to spend on those commissions. So commissions have become a much smaller part of the equation than they used to be. And then also, if you're doing it right and you're able to generate income that offsets, in the case of what those guys are doing over there at Swan, perhaps even double the amount that they're paying for that protective put, then that is certainly a value add on behalf of the client. I can't imagine any of them coming back to you and saying, wow, you're paying too much in commissions to generate this 2x the price of my put. I want you to curtail that. So it really depends on the implementation, obviously. If you're doing it in the case where the commissions are becoming a distracting factor, they're taking away too much from the account, then you probably need to take a step back. Maybe that gets back to a conversation earlier about the weeklies. And, the weeklies can certainly be an attractive area for a lot of advisors to dive into and start writing options aggressively. But if you're not doing it in a proper fashion, that could certainly come back to haunt you in terms of execution costs, not just commissions, but of course the bid-ask spread. If you're executing those trades, let's say in a less than savvy manner, that could certainly come back to bite you as an active advisor. And that perhaps is maybe a good topic for a future show as well, how the weeklies should weigh in an advisor's portfolio and what some of the proper use cases and perhaps some of the improper use cases are for implementing the weeklies into your clients' accounts. So great question there. In fact, great questions from everyone who wrote in today. I want to thank all of you. You guys have really been a great audience. I know a lot of you are writing in saying we want more of these episodes. We want more of this show. We want more of this show. And we're working on it. We're trying to get you more episodes on a regular basis, getting everyone's schedules to coalesce, to put together a show like this on a regular basis. It's a bit of a challenge, but we're working on it. We're hoping to get more episodes for you because we know this show, like you guys said, is unique. No one else is really hitting on this stuff. And we want to make sure that you guys out there in the advisor space have a show you can turn to answer questions and to vent your comments just like you guys did today. So we're hoping to have more mailbag segments going down the road. This was just we wanted to get to a bunch of you who had written in, and it seemed like a great thing to explore for today's episode. But unfortunately, that's all the time we have for this episode of The Advisor's Option. I, of course, want to thank my co-host, my partner in crime, good old Randy Swan, over there at Swan Wealth Advisors. And Randy, before we sign off, we hit on the mutual fund. Anything else you want to leave our listeners with that's exciting, that's going on over there in the world of Swan that they may be interested in?
Well, actually, our firm is going to have a booth at the Pershing Insight Conference next week in Fort Lauderdale. So anyone that is able to make it out there, please stop by. Happy to announce that our fund just last week hit $200 million of assets. So we've been growing pretty quickly, and we expect good things going forward.
Well, it's great to hear, not just for you guys, but the fact that there is so much interest in a fund that implements options like this. Traditionally, we haven't seen the advisor space embrace these types of products because they're terrified of them or they don't understand them. So to see so much traction coming into a fund like yours that uses options, unlike in the article, in a proper way to actually mitigate the risk of your clients and generate some income, that's an exciting thing to see the advisor community and the asset management community in general starting to embrace an approach like that.
Absolutely.
So, of course, listeners, we want to thank all of you for joining us today on the Advisor's Option program. And, of course, we're going to get more of these episodes out to you in some meaningful fashion. We're working on that right now. But on behalf of Randy and, of course, Mike and Alan, who couldn't be here on today's program, I want to thank all of you for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.